So real estate investing can help you pay less in taxes legally. Now, the IRS code is written in a way to encourage and incentivize certain behaviors and certain investments. The activities that the IRS really wants to encourage are things that are going to provide jobs, stimulate the economy, and make life better for the typical American citizen. So real estate investing is one of these big items that the IRS is really looking to encourage through their tax code. And as a result of that, there's several things that we as real estate investors are able to do to lower our annual tax burden. Now, why does this even matter, right? Legitimate question. So building wealth really boils down to a couple of key factors. It is not just about the income that you're able to create for yourself and for your household, your family. It's also how much of that you can keep. If you're paying 40% out to Uncle Sam, that chips away at that pretty fast, right? It's also then, after you factor in what you're able to keep, what you do with that money. Are you spending it and blowing it on crap that isn't going to improve your life, material stuff that doesn't really matter? Or are you investing it in things that are assets that are going to spit off cash flow and appreciate over time, right? So a lot of our investors are self-employed. They're business owners. This is an item of concern, lowering your taxes for a high-income W-2 employee if they have a lot of different investments. But this stuff becomes really, really important if you're a business owner. You can be making a pretty good income, and then Uncle Sam comes around come tax time and smacks you around a little bit, right? So a lot of business owners, the really smart ones, the ones that are generating significant income, are always looking for ways that they can legally reduce their tax burden, right? So real estate can help to do that in a couple of different ways. So we're able to deduct our expenses. That is a way that we're able to show less income for our tax returns, pay less taxes. There's something known as a 1031 exchange, which allows me or anybody who has owned a piece of property for a certain period of time to sell that property, defer the capital gains on the proceeds, and roll that cash into a brand new property, essentially trade up properties over time without getting hit for taxes each and every time. Now, when somebody utilizes the 1031 exchange, they're simply deferring those taxes to a later time period, but it really helps somebody to grow their net worth while they're doing that. Depreciation is the third. What I'm going to really talk about in this video is depreciation. So an asset depreciates over time. Your car, we could get into an argument as to whether that's an asset or a liability, loses value over time. Real estate loses value over time. Depending on the type of real estate, you're looking at either a 27.5-year time period or a 39-year time period where you're able to depreciate that piece of property, reduce the value. And so if you think about it, properties require maintenance over time, right? They get old, there's wear and tear, things break, and things have to be fixed. And so we're able to depreciate a certain amount of the value of the property from the income, which enables us to pay less in taxes every single year. This is a really, really cool thing that as real estate investors, once we understand this, we can really use this to benefit ourselves. This is something that really almost no other investment vehicle or class of investment offers. You can't depreciate stocks. You can't depreciate precious metals. You can't depreciate cryptocurrency, right? So real estate is one of the few things that you're able to look at from an investment perspective that provides this sort of tax benefit. Now, our team, when we're doing multifamily syndications, and our investors, by the way, absolutely love this, we do something known as cost segregation. What this means is we are allowed to separate a lot of other items from the real estate itself. So let's just say appliances, okay? Appliances depreciate, they have to be replaced. They depreciate much faster. If you've ever bought a refrigerator, you know that those things can deteriorate pretty quickly, right? So if we have 100+ unit property, this, depreciating your appliances might not sound like a big deal. But if we have 100+ units and we're able to depreciate all of those appliances completely separately from the real estate at a faster time horizon, a faster basis, what that allows us to do is to essentially front load the depreciation during the early stages, the beginning years of a real estate investment. Now, this is really relevant for us because our team is typically buying, implementing a value add strategy, increasing the value of the property, and then selling it in 3 to 7 years. And so if we're looking at a 27.5 or a 39-year time horizon, we're leaving a lot of depreciation on the table. So what we do is, like I said, we do this cost segregation analysis, which allows us to front load that depreciation, the early life cycle of the deal, and maximize our tax benefits while we're in that particular property. Now, each year, we're using that depreciation to, again, reduce our taxable income. You're able to take this and apply it towards the income that your business or your other investments are spitting off. Now, to get into the weeds here and really understand how this is going to impact your personal situation, you're going to need to talk to a CPA. You're going to need to get with your accountant. Everybody's situation is different, and I do not have the time or the background to get into that, especially in this particular video. But we're helping our investors reduce their taxable income per year that they're in the deal with us. Now, there is a recapture when we sell the property. There's a percentage of that depreciation that we are responsible for recapturing, right? But if our investors are continuously investing in new deals with us, that helps to mitigate that and helps to lower that when there is that recapture. Now, again, it's a percentage of the recapture. So if we're in a deal for 5 years, we are reducing our taxable income for 4 years. There's a percentage of the recapture year 5, right? So we still wind up way out ahead and in the black here, right? So if this sounds interesting to you, if you're a high income earner, if you are running your own business and you're looking for ways that you can reduce that tax burden, we should speak. If you're looking for a passive investment opportunity that will help generate cash flow, help you grow wealth, but also help you keep more money in your pocket every single year, we should speak. We have a link to our website down below this video. Go ahead, check out our website. We do have a free ebook on our website that talks more about how we help folks grow wealth, more about our investment strategy. We would love to have you take advantage of that free resource, and we would love to speak with you and see how we could help you in the future. Take care.